Well, thank you for showing up. I was concerned. I was concerned that the bad weather would blow you away and we wouldn't have lunch. But it's nice to be here. And Atlanta is a special society, and I've had the good fortune to be involved with the CFA for a long time. And Atlanta has always been at the forefront. Many people here and among your society have been on the board and graders and PCs and very involved, and we've always viewed you as one of the most progressive societies, and so hats off to you. And I'd like to also give a special thanks to Kathy Ford. You can't imagine all the stuff she does to have this work, and so I would give her a round of applause. Then a little commercial, the Research Foundation, which is near and dear to me, on your chairs, and then some more out there are some of the monographs they've written. These have a good long shelf life, and I would recommend them to you. They're a good way to keep current, and they're nice. All the iPads, these are small, they're nice to take on airplanes, so what have you. The Institute, I do this at different societies, but the Institute recently said, let's have, I think earlier this year, let's have Client Appreciation Month and Treat Your Clients Well Month. And I thought, what do we do the other 12 months of the year? And I thought that stewardship and fiduciary, it is in fact at the core of the CFA. The CFA holders and candidates are, in my opinion, a level above the other people in the profession, if you measure it by that, because they've gone through this. And as you know, that 15% of the exam is ethics. And people come and trust CFAs because they expect us to be fiduciaries, and their best interests are paramount and way above ours. So it's kind of silly that we even have this conversation about being good stewards and good fiduciaries. And I think all the people in this room clearly are such. By evidence, you've showed up to this meeting. You care, and you are more than just a portfolio jockey. You really are trying to do something in a very challenging world for your clients. So hats off to you. And so a lot of the negative things that have happened are not amongst the people in this room. It's those other people that we need to do this. And the government's now coming in, and there's the DOL fiduciary laws, which is a mess at the moment, but it's evolving and hopefully it'll resolve to some sort of sane solution. But right now, as it's printed, it's not too sane. So what happened, to the old code of ethics of CFA. Our firm, when we fill out compliance, they say, what's your code of ethics? And we say, we comply with the CFA code. There's nothing better that we're aware of. And so that's that. And so that code is very much there. But one part of the code that is not in the code is, the golden rule. We all know the golden rule. That I have the grand rule. If you're faced with a difficult decision about your client and your business, think of the grand rule. And the grand rule is very simple. What would you want, and here I'll do demographics, your grandmother or your granddaughter to think when she heard how you decided that? So make the decision that would please your grandmother or grandfather, and you'll be fine. And I really think that's a pretty simple rule. And if we did that, I think would reduce some of the confusion. So how did we get to the point where even this conversation of good ethics is even on the table? This is a slide that's partially visible, and what have you. And this, we've spent 20 years creating a process, a sound, logical, repeatable process that gathers all the players together, the investor, the committee, the consultant, and the manager. We're all there to serve the investor. But as the introduction said, it's not working all that well, and people have been trying to get out of it, and they can't get out of it because we've spent two decades convincing people this process works and that we should do it. But no one's standing up and saying, stop, let's revisit this process and see if we can skew it differently. And what's the weakest link in the process? The committee. The committee, none of your committees, none of the committees you serve on, of course, but the committee is a committee process, and it's not a very good process. Individuals will do things as members of the committee they wouldn't do themselves. And yes, this is kind of inappropriate for a CFA meeting to put this up there, so I apologize to Miss Piggy. But this committee has been involved, and you've seen them. They do things that are not necessarily in good form, and that individually they don't really like the outcome, but they go along with it. So this is kind of the catch-22 herding. What have they done? And this is the fool's errand. The committee in this process has redefined risk. We've increased and encouraged herding, and we have become asset gatherers. Let's go to each one of these. Redefining risk. On this part here, risk is what? Capital risk. Your client is concerned about their capital growth and preservation. So all of our efforts should be dedicated toward that risk. But what's happened over time is that we've redefined it. We now spend an inordinate amount of time talking about benchmark risk. Stop. The next time you go to a meeting, put peer, benchmark, capital, and job risk on a piece of paper. And then in the conversation, when one of those risks is talked about, put a check mark. And I predict at the end of the several meetings, you'll see that capital risk is the least checked one. We spend a lot of time talking about benchmark risk. Benchmark risk is an important factor. It's an important part of analysis to figure out why the manager is different than the benchmark. And sometimes that's good and sometimes it's bad, but understanding why there's a difference is important. But what happens is they're different. If it's good, you give them more money. If it's bad, you might take some away or fire them. But we're not analyzing the benchmark. And the benchmarks were originally created to try to identify a performance pattern of a manager. In fact, when I was on the board, we caused to have a complete conference in Chicago on benchmarks. What are they for? Their original goal was to see if this manager acts like a value or growth manager or what have you. But they morphed into becoming the objective. And the style benchmarks are not made in logic. They're skewed by mathematical formulas, and they don't create necessarily an economic portfolio you'd want to have. The mid-cap one, the one I'm most familiar with, at times 50% of the index is in interest rate sensitive, housing-related companies, because they have low PEs and high yields. And there are times where that's okay, but there are times that is the bubble. So the benchmark is not a spendable kind of thing. You can't go to the grocery store and say, we're going to give you money or benchmarks. They're not negotiable. But we're possessed with it. The other one is peer risk. Everyone is interested in what Yale looks like. And John did a wonderful job there. He did a great job. But is every university the same risk profile tolerance as Yale? No. And so what the peers are doing should be interesting, useful information, but what's really important is what's your foundation endowment's risk profile, and that should be more important than the peers. And then the job risk, this one's hard to measure. Everyone in that group wants to be reinvited, the manager, the consultant, and the professional staff. And so their job risk sometimes gets in the way of their ability and willingness to serve the client. And then finally, capital risk. The investor someday is going to wake up and look around the table and say, your definition of risk isn't mine. I'm really interested in my pension fund, my endowment, my grandchildren's funds, and you're not as interested in that. And they may eliminate the whole group. So I think we have to refocus on the risk that's the most important to the investor, and that's capital risk. Herding. Herding is part of, this is the wildebeest. Every 6 or 8 months in the Serengeti Desert, the alpha bull smells water and he starts charging for water, and hundreds of thousands of wildebeest follow them. And they literally shake the ground 5 miles away, charging to this water. And this is just like Wall Street. Wall Street is sometimes, a nonsensical charge to whatever's working. And if you're lucky, you're deep enough into that crowd that the ultimate goal of getting to the river, you're too far away. Because what's in the river? 2,000-pound crocodiles are waiting there for lunch. And it's the wildebeest. And they charge, and they feel like they're safe, they're sound, they're good fiduciaries, and they're part of the group. And I can never be criticized for being part of the group. But they're headed to a disaster. And so you want to make sure, if you had a choice, are you going to be the wildebeest or the crocodile? And we're never going to solve herding. And what's happened is, with information and all this, actually herding is accelerated. And that creates bigger bubbles. Because the herd instinct, money chases performance, money chases benchmarks. This is a chart that there's about 10 variations of this. We all know what this is. And some of you sit in meetings and you know exactly what's going to happen. This is like on a mountain in a tablet. This is the performance of the manager before you fire them, after you fire them. This is the performance of the manager you hired, and this is the performance afterwards. This goes on over and over and over again, and pretty soon what happens? The money's gone because they pay on both sides of the mountain. And if you're not happy because someone's not keeping up with the market, and they happen to be an active manager, which is what you want, and they're saying, I'm a manager, and we're trying to capture return, and most of all, we're trying to manage risk, and we're trying to avoid a risk that's in the market. And you can go back to every bubble, technology, energy, subprime lending, it's all part of the herd instinct. And some managers say, this is too risky. It's going up, they can't buy enough of it, and the stampede is pushing it, and they're saying, no, I'm going to back away because it's too risky. The risk reward's not there. And so they track. And when you do that, there's a fork in the road. One's fundamental valuation and one's momentum. The minute you start doing what you're supposed to do, the gap widens. And you get fired. You get fired. And then, so they want to hire someone who's done a better job. Well, if the wildebeest are charging and technology is the lead, then you find someone who's got more technology than the market. So what have you done? You've gone out of the proverbial pan into the fire. Total disaster. It goes on over and over and over again. And a friend of mine, a consultant, presented this to the committee, and he said, let's go through and interview and look at all these managers. Don't look at performance. And you know what happened. They picked a manager. It was almost unanimous. It was scary. And then they put the performance up. Can't do that. These people have underperformed for 3 years. Why would we hire them? And they actually trumped their decision non-performance. They actually tabled it and came back and hired the hot numbers because they just have to. It's just congenital. And this pattern has created a new industry, the CIO. The CIO. And one of our private clients is an extraordinarily smart CFO of a major company, and he's on 3 or 4 boards of pension funds. And so we were hoping selfishly that we could help him This is not his personal money, but managed money for these DBs. And he went 1, 2, 3, and he ended up hiring a CIO for all 3. And I said, Bob, you have your money with us, why not that? No. You don't understand, nor does the committee. I fired them, but they don't know. Because they were doing a terrible job. He said the money was going to be gone if I let them go for another 20 years. So they hired a CIO. Because then the CIO, good ones of course, they're not subject to the committee thing. So a void has been created and people come in and fill it. So we're in the full employment for a money manager's business, right? But this is so hard to change with a committee. Here's another stampede, and this is indexing. Jack, you can't see it, but Jack Bogle gave me this. And back in 76, 5, 4, 3 in there, he started Vanguard Index Fund. And it was 0. No one had heard of that. And Jack Bogle started it in Philadelphia, Dean LeBaron started in Boston, and Jim Burton started in San Francisco, almost within 3 months of each other, the index fund. Now, it now represents 34% of the assets. Wow. And so there's about $4 trillion in equities and 34% in index funds. Then you add on another 10 or 15% that's ETF. And why are they doing this? Well, active managers have not performed. And this is a way to be part of the wildebeest. You will never underperform by much. You'll be with the crowd. So this trend's going on. Here's another version of it. This is the money flow into active management. It peaked out about the time the market peaked in 07. And here's the money flow into index funds. Bogle told me that in the first quarter, he got up, round numbers, $120 billion in, and BlackRock got $80 billion in. Of that inflow, almost 75% of it went straight into indexes. Bang, bang. And that's continuing, and that's a big trend. Here's another one, another chart, and there's dozens of these, but here's someone did a study that said in 1980, 60% of the mutual funds were considered active. 2006, it's 19%. So the rule at 20% outperformance is kind of interesting. Only 19% are trying, so where's the other 1% coming from? But what's happening here is that mutual funds and managers have learned that if they do the right thing, and this is the key point, this is where the rubber hits the ground. The key point is, can the money management organization, a partnership or corporation, can they and will they take the business risk to deliver what they promised? And what happens is, you have a tracking error in your mutual fund, money goes out. And the CIO comes down to you, the manager of that fund, and said, well, what are we doing here? Well, I'm following what we're supposed to, buy low and sell high, and don't follow the wildebeest, and we're tracking. Well, that's good that you're doing a good job, but this mutual fund has a purpose. One is to make money for the client, and the other purpose is we get a fee. And we have money going out, we don't get a very big fee. And you may not get a bonus, and you may not have a job. So maybe you should look more like the index. So what's happened is they're taking fewer and fewer judgment bets against the index because of the job risk and because there's too much business risk in it. So they're snuggling up and they're saying, I'm going to be a closet index. So the question here is active management dead? Is indexing the new deal? And this is a slogan, I love these things. Never pluck the beard of a dead lion. Why? You may not be dead. Bite your arm off. Active management's not dead. They got big teeth. There's not many left. and there are going to be fewer left. But the ones that are vertical are going to be okay. They're never going to be huge because the real money as a money manager is in the asset gathering. The tougher money is in doing fundamental investing and making judgments as to what risks to assume and what risks to avoid, and have a style you adhere to. And that's pretty simple stuff. But that's all an active manager says. What style do you have? Stick with it. Assume some risk the market doesn't have recognized yet, and avoid the risk, because at a bubble, what happens in the index? The index always owns the most of the most overvalued and the least of the most undervalued. Now, if you talk to this wildebeest group and said, I'm going to give you an investment, and at every peak you'll own the most of the overvalued and the least of that, what do you think they'd say? They'd say, well, that doesn't make any sense. But that's what they got. Because benchmark huggers and indexes are, by definition, momentum vehicles. Our particular benchmark REITs used to be 1.35% of the index in 1997. It is 16% today. Is it really 10 times better? No. It's gone up. So when it goes up, it gets worse. And so the demand for indexing is not going to go away. Every 2 weeks, some number like $500 million or more, I don't know, some number, 50 billion, pick a number, it's huge, and then add something to it. Every 2 weeks, payroll deduction. Money goes into 401k. 80% goes to index every 2 weeks. And the new DOL, what professional manager or financial planner is going to suggest a index active manager to an IRA? The new rules say, if it doesn't work, you got a problem. So who's going to recommend these? Not very many people. And so the indexing is in place. And I would submit to you that's probably in the 4th inning. That's terrible, but that's where it is. And I'd love it to be in the 8th inning or in the 3rd overtime. And the bases are loaded and you get hit with the ball and you go to first and you become a hero because you go to first and prove a run in. So that's an RBI, so that's not bad. But it is here to stay. And if it continues, and if you believe me, it will, what's going to happen is you're going to have enormous wildebeest money that's indiscriminate. It's going to buy on a cap-weighted basis in the main. An indiscriminate flow will create opportunities because it's not paying any attention to valuation. It's just, this is 8% of the index, and I have money and I want 8%. There's no judgment. There's no judgment. And so it'll just keep doing until opportunities are created, because indiscriminate flow creates nonsensical valuations. And so at some point it'll be a heyday for active managers. And I can tell you as an active manager, it is not here yet. We've not seen it yet, but there's flow. There's flow. And I'm talking about flow is going to drive the market, not the lady on the Progressive, insurance thing. I'm talking the flow of money. It's going to continue. And so you come back to active, passive, and then the rudimentary question is, should you be active or passive? Passive is, number one, very easy, very cheap. There's no conversation. The board's not going to sit around and discuss the index performance. It is what it is. So it's a low risk, low decision-making opportunity. You will never, ever outperform the index, and that's okay. But it's not fun either. What's the committee going to do? Let's analyze this index. Well, there's nothing to do there. You can't talk about the manager. So active management, and I say to people that active management is not for everyone. It is clearly not for everyone, because active management requires patience and knowledge and patience, because there's an inevitable period where the manager is going to be out of phase. And if you're going to fire low and hire high, you shouldn't do this. And if your committee is benchmark-centric and obsessed with it, then do them and the institution a favor, make it all index, or so much index it's not going to matter. But I think that's are we running out of batteries here? That's important decision. So indexing is not for everyone. Active management is riskier in the sense that it varies from the index, but if the manager's doing the right thing, and today is a time in the market where we're in a 9-year bull market and there's excesses, and let's just say for fun that the excesses had something to do with all-time low interest rates. And FANG, a new acronym, look at these new tools. It took forever to figure out what the G was. It's Google, I think. And so these things are where the wildebeests are going. Those may represent the bubble. And if an active manager is avoiding those, he or she is underperforming, there's risk there. And if you're going to let that bother you and not understand that they're doing what they're supposed to do, you're going to fire them, you're going to cause yourself problem. But these inevitable periods will never stop, and they just keep coming. So if you can't have the patience to deal with that and accept that, don't be active. Active also is a way to have the capital markets fit you, because you can control to a better extent what you're invested in. If you want to have high PE, high growth, or low PE, low growth, value, you can do that through active management. But you have to take the index as it is, so you have no control. You have a chance to outperform in an active management. There'll be periods where you'll significantly outperform, underperform, or over a long period of time. If it all works out, you should have the same or better. And you could make the case that if after 10 or 15 years you had the same return, you could almost declare that a victory, because maybe you got there your way, higher risk or lower risk, and I controlled that pattern. And another way to do it is probably the smart way, and I see more and more of this, is you say, we don't have to choose between these. Let's have a combination. And design the combination upon the investor's willingness and ability, financially and emotionally, to deal with variations. And if you make a package that has that volatility wrapped around that investor, what will happen is they'll probably get to point B in 10 or 15 years, but the total variation of their equities will be lower. So if they had a lower standard deviation, a lower volatility, a lower opportunity for committees to make bad decisions, and you get there, that should be worth something. And so that's the thought process you need to go through, and probably some variation that makes sense. And we're seeing more and more people saying we want to have some balance between active and passive, and they rebalance with that. And if they think the market's high, they go to active, because active has a history, normally, of outperforming in down markets. And passive, if you think you're in the beginning of a bull market, you want to be very passive, because they own all the stuff. The stuff that almost went broke, that goes from 20 cents to $6. So making those judgments, another wrinkle of asset allocation. Now, how do you find these active managers? There's not many, and they're not in the great big household names, because it doesn't work there. So you have to find smaller, independent money managers that are probably privately owned, and that probably are the principals invest with you, and probably has people that say, I'm not going to have a gajillion dollars. I don't want too many accounts and too many assets. I just want to manage money this way, and gather people who have like minds. They're harder to find. And so you have to look for them, and it'll get harder. So, passive, active, passé. Passive's going to grow. Active's going to shrink. Passé, which is the closet index, is going to disappear. Why would you give closet index 50, 30, 60 basis points when you can get from Uncle Jack for 7? That business is gone. Other than the 401k, they got great bookkeeping, glossy pictures, mailings, marketing. The HR loves them because they show up and they add up, and they're covered, and they're not going to get sued. But other than that, the need for a passive manager is going away. Purposeful, so that's the poppycock that goes on now. Let's talk about real investing, purposeful investing the way we should do it. Purposeful investing doesn't get all confused with this stuff. And here again, part of it but Occam's razor is one of my favorite things. Occam's razor, if you're familiar with it, he's a 13th century philosopher. He was a chemist, a priest. And he said you take complicated situations, whether it's an investment, a relationship, and you boil it down to a few critical variables. And you focus on those critical variables. If you're a stock picker, what's going to make this stock do what we think it's going to do? There's 5 or 6 things that have to happen. And you focus on those. And you let the noise, which is oversupplied in Wall Street, talking heads, this, that, and ignore that. You can go to a concert, and you can go and listen for the coughers, and the people who shuffle around, the whisperers, and the occasional phone. Or you can go listen to the violin. If you ferret out the coughers, you'll actually enjoy the symphony. Well, managing money is the same way. If you focus on the violin, the things that are important, your odds of succeeding will go up. And if you kind of push that away, that's interesting, but it's really not going to move the dial. So Occam's razor, and again with the active part, you don't have to be active to have this, but you make this thick line. This is what I want. This is the capital markets in its total wrapped about me. And I'm willing to accept variations from the market because I don't care. I have a goal. 5%, whatever it is, I have a goal that's mine. And I have a path that fits me in terms of my risk tolerance and liquidity and all those things we study. And I'll take that line and I will accept periods where I'm not as good or better. Because that doesn't matter. That's the coffer. And when we're doing this, risk reward, this is connected with the slash. Most people in our business try to detach the two. You cannot detach the two. Risk and reward are not linear, but they're connected. So if you want a higher return, you have to have a higher risk probably. And your odds of getting there improve, but not necessarily. And in terms of reward, there are only 3 things that matter. This used to be earnings per share, earnings growth, but I changed it several years ago to cash flow because, frankly, we can't believe the earnings per share. It's contrived. Whatever the CEO needs, the CFO comes up with it within the generally accepted gap. And then if that doesn't work, we say, here's our number. We're going to exclude the things we don't like. The plant we had closed, the acquisition we wrote off. So these are Bob's numbers. So just forget gap and all that stuff, Bob's numbers. And first call, if you have gap and you're too far out of the range of first call, they throw your number out. That's crazy. Where did that come from? It's not meaningful. So earnings per share has never been that good. Cash flow. You can hide earnings, but you can't hide cash flow. Follow the money. Jesse James. How much freight cash flow do they have? What do they do with it? Did they make Goldman rich? Or did they make some sensible acquisitions? And I say, hey, I'll give you the dividend. And that's another one, is the dividends, very important. And then the third thing you can't see here is the valuation. So cash flow, dividend flow, and how much am I paying for it? That's all that matters. Occam's razor. Focus on those 3. And don't get hung up whether Walt Disney's good this month or leisure suits. God, remember those? You guys don't know that. Leisure suits were the hot item. People wore these awful looking things with flowered shirts, but the blazer has always been in. The blue blazer is there. They just change in size. They shrink. So you want to be the blue blazer when you're investing. Here is an interesting chart, I think. This is the decades from 1920s all the way through here. And the bar is the total return of the stock market. And the green is that portion that is represented by the dividend. And there's been like 40 years where the dividends haven't mattered, other than in 29 in the O's, when the stock market actually had a 10-year decade down. But the far number, you can't see it, for the entire 1926 to 2016, which is about 90 years, right? 40% of the return. 40% is the dividend and its growth. So buying low and selling high is only 60% of the game. So this is surrogate for follow the cash flow, fundamental analysis. So the dividend is surrogate for free cash flow. It's really important. And there's conceptual investing, which is a whole other world, hard to analyze like we did in the 99s, but real returns come from analyzing cash flow. Now you predict what's going to happen. I have no clue. But here's that 90 years. The total return in the stock market's 10%. And 1.2 of it came from multiple expansion. Had this index started in the 30s, it wouldn't have been there. But because the PE was low in 1926, 1.1% points of that return is with multiple expansion. From this point forward, multiples are high, they're not excessive, but interest rates probably will go higher. When interest rates go higher, the capital markets shrink valuations, right? So going forward, if your client says, what should I expect in the next 5 to 10 years? You'd say nothing from valuation. And you might get a 1 percentage point shrinkage. So let's call it 0, be optimistic. Inflation is running around 2%. That's what's been for 100 years, so let's just say 2%. Janet's looking for 2%, so let's say she's right, okay? And then I'm sorry, that was earnings growth, 2%. Inflation was 2.9, but she's looking for 2. Let's be optimistic and call that 2. And then the one you can't see is the dividend. Over the 90 years, the dividend accounted to 4 percentage points. What's the market yield today? 1.5. So let's go through, get your HPs out, and let's do 0 plus 2 plus 2 plus 1.5. 4.5 to 6. That's it. Mr. Market's telling you that that's it. So don't go out and promise 10. Don't go out and look for 10 unless you really want to go out on the limb. That's it. And Mr. Market will torture you. He's really good at this. You can't out-time him, and you can't out-fox him. So the return from equities, domestic equities, are 4 to 6. Accept it. Go home. Manage money accordingly. Don't deny him. He's good. He's better than you. So when you're making these promises, think about that. And the real key, patience and courage. The patience to be different, if that's what you want, and the courage to stick with it. If you have those two, that's much better than intellect or hard work. And two more P's. Prayer, and please help me to whoever will listen. But the patience and courage are the key. So that's it. I threw out some thoughts about active, passive, and you did your own forecast, so we won't debate that. But now's the fun part when, we ask questions. Yes?
So I have 2 questions, and you can pick which one you want to answer.
I like that. Yes and no.
Okay. So the first one would be, why stick with style in the first place? Why is that so important? If you can see there's a problem, why not jump out of your box and go someplace else?
Okay.
And then the second question is completely different. Is standard deviation a decent measure of risk?
Second one, no. It's all we have. When the portfolio is risky, well, how do you measure it? How much movement it has. The market's risky, how much movement? The VIX. Well, the VIX is sort of out of it. But and the standard deviation just tells you how the portfolio moved. And in a bull market, the standard deviation is low because it goes up. And a manager who's underperforming in an up market, he'll show the worst thing in the world, which is why they fire him. He gives a lower return and a higher standard deviation. So that's kind of worthless. And down market's the opposite. The standard deviation is up, and the return. So, but it's all we have. It's a measure, and it ties into the style thing. The reason you pick the style should be revisited. Why did I pick growth or value? Did I pick it because it was cool? Because it was in working? Or did I pick it because that's where I am in my risk zone? And if you're in the risk zone of high growth and it's not working and you go to low growth, value, you're going to be market timing something that's even harder than market, and that's style movements. And the style movements have kind of morphed because even the Russell has, a third of this one's overlapped in that because they can't decide what it is. But a style switch is really an extreme form of market timing, and it has to come back to why did I pick value? People generally pick value because the farmer French says that long-term value beats growth. Bang, period. All the data. There's periods where it doesn't, and if I like that and I move to growth because your motivation would probably be because growth beat it. So what are you doing? You're detaching valuation, you're chasing mo. And that would be my answer to that. Both of them.
Well done.
We'll see what's right. Someone else. How many think indexing is in the third inning? How many think index is in the seventh inning? The rest of you really can't. Yes, sir.
This is a totally open-ended question. I do
I
not have a
don't
preconceived
answer it any
idea.
other time.
It has more to do with, I'm hearing a lot of marketing. What do you think of, or what would you say about enhanced indexing that we hear about so often from a lot of advisors?
Yeah, I don't know much about it, and there's smart beta, which is a form of that, and Rob Arnott got he trademarked a piece of the index, which is not wrong, but his is a value band index. He'll say it's not, but it's a value band. It's a way to take an index and try to do what we talked about earlier, make it fit you. You can take an index and say, I want the growthier part, I want the lower value part, and I don't know how successful it is, but it would be a way to take an index, and all the custodians have a way to do this. ETFs are a form of that, I think. And you can then say, okay, here's the index, whether it's the US or whatever, and I don't like the total index, but I want to tilt it. And if you know what you want, not a bad way to go. Smart beta, I did a panel where we had active and passive, and smart beta was, sound kind of interesting, but it sounds to me like a form of Rob Arnott's fundamental indexing, which is the way to add something besides cap weighting. And equal weighting is really better. But we learned that it's cap weighting, so everyone does it. Right? That's another thing that doesn't work. We had a meeting with one of our clients, and they said, we have 7 of you people in Bowl, of course. And you're the only guy that doesn't own Apple. And I said, well, we've got the fruit company Smuckers, does that count? But people will own 6-7% of Apple. Well, why do you have that much? Well, because that's the index, and my main competitors have 7, so if I'm going to beat them, I got to have more than 7. That's your money. They're gaining benchmark and bonuses and the ultimate 5-star. That's insane. That's not investing. That's momentum. That's trying to keep asset gathering from flowing out. Then when it blows up, we're saying, hey, we all lost 40%. You got what you wanted. So why fire me? You keep the money. But the active managers had better do a lot better in that period, because you lose 50, you got to make 100. So the way to measure active passive is generally in the down markets. How has this active manager, I'm assuming value, forgive me, done in down markets? Growth might be another deal. They win in the up markets, but traditionally it's been that way. Yes, sir.
Can it be a marketing strategy because indexing is popular? So if we look at the enhanced ETFs indexing compared to the old days we used to call closet management, many fund managers, although it's a wrong, I don't mean to point they were very close to the index, but they just tinkered with it a little bit. That's how we got the word closet management, right?
Right.
So the smart indexing, and if we compare that with the closet management, they're not that far away from each other from an active management point of view, but it is a marketing, branding. So how much you think that might be playing a role?
It's part, I don't know how much.
And
they-
I have one follow-up comment.
Yeah,
After-
go ahead,
after
go
your
ahead.
comment.
Go ahead. If you all can hear him, go ahead.
Now, whether we accept or not, because of the volume of money collectively we all manage, we can't avoid trends. It's a human nature. Now, because we have rightfully or wrongfully, on a concerted global basis, central banks are giving enormous amount of liquidity. Many people argue or agree or don't agree, but at the expense of our grandchildren. But whatever it is they are giving, but they can't stay on the tiger forever. So then, how much of that has to do with the savings? And if and when, I personally doubt Janet Allen will ever normalize the balance sheet, and most likely she will be re-elected. But if that is not the case, there is some reduction in the balance sheet. How that will change this ETF phenomena? So that, just to
Yeah.
be knowledgeable person.
The first one I'm more comfortable. Yeah, it's a market. It can market. You know, I'm a money manager, and then we don't bother stock picking. Market timing, we just do indexing, and it's cheaper. It's a great marketing tool.
No, I don't mean stock market. We give our salespeople marketing our products.
Right.
And they have whatever rules that marketing strategies they need to play. And as managers, we have to redesign our products to suit their marketing efforts. That's what I mean, not the stock market.
Oh, okay. Part of the asset gathering is my flippant answer. I mean, if you need to get money in, you find out what people want. And Wall Street's wonderful for designing products to meet needs. And that's what they do. So that's going to continue. And someone will do something, well, all these smart beta, there's a way to take the whole concept of indexing and say, here's a better way to index. And they'll sell it. And the second one, I don't know enough about that world, but so I'll pass on that one. Forgive me on that. Yes, sir.
What would be your response to a comment that maybe there's too many money managers out there right now? Perhaps industry consolidation in the long run ought to benefit active managers.
Correct. And the guys who are, and the gals who are going to go with the passive, not the passive, they're out of business. And I'll call their product, and I hate that word, but their products is just like Amazon, Walmart. Their product has very little use. People want value. And if I can never outperform in a passe index, then I'm going to pay Jack Bogle 4 or 5 basis points. So I think that technology displacement of a whole money management sector. The active management, I think there's going to be more fall to the wayside, or they say give up. I'm going to be a closet index, and I think that's a shrinking pie. I think that our business is not immune to technology, and distribution is what Walmart and Amazon are about, and it's what money management's about. That channel is going to shrink.
Do you think the fewer money managers in the long run, the better, as a money manager, your returns could be with less competition?
Yeah, in that sense, but what's happening is consolidating. Bogle's really concerned that he and BlackRock and Fidelity represent almost a monopoly, and there's very little government regulation of them. He's really concerned about that, and that's a good thought. And are more money managers better? Well, the asset gathering is all about volume. You don't have a lot of expensive analysts, you don't need them. So it's just a computer. Yes, sir. You asked, you got your hand up.
Yes. What would be the sign that we should watch for that we're about to change direction and see active management begin to grow again and take over? Or is the ultimate outcome it goes to zero?
I don't think it goes to zero. There'll be a need, there'll be people who are willing and able to take a tack different than the index and they'll pay for it. I think the number of people purveying that service are going to shrink. And the time that it happens is when there's a crash and they realize the index has lost 40% and these guys lost 25 or 20 or 30. And that's an event that, but it really hasn't, on that, it didn't change it. You saw that one chart, it accelerated. They because so much of it's mindless. And I don't mean unsophisticated. We've done a good job, Bogle and company, and these 401ks. Just set your thing, do these. Another one I forgot to mention is these life cycle index funds. They're all indexes. 21-year-old buys this thing and it's due. And so it's all passive. And so that part's going to grow. And that's fine because those people are better off because you can't jiggle the stuff around. But there'll be a subset of the investors who will say, I believe in active management, and I'll put 10, 20, 30, 40, whatever number in active management. I don't think that'll go away. And those people will be the ones that say, the indexing is a momentum and I want some balance. So it doesn't go to zero. We've always, our business is based upon hope and trust. Hope's never going to go away. And so there's an opportunity there, and I really do believe that. But it's the pie shrinking. Yes?
So in this low return, low yield environment, clients are increasingly looking for higher returns and they're going into the illiquid private equity deals or you're seeking more of that.
Right.
It's become a big part of their portfolios.
Right.
So what do you think about the active managers who are trying to, who manage these deals, and what are your thoughts on that?
On the private equity?
Yeah.
Well, we have the good fortune, 3 or 4 of our family people, investors, are private equity people. And they're at the point in their career where they're not investing 110%, and they're giving us the money. And you talk to them, and you say, Cam, you just got $1 billion in your private equity fund. Yeah, great. What are you going to do with it? I have no clue. I'm going to get a 2% fee while I look. This isn't bad. Those of us pounding salt for 70 beeps. And then he said, the other problem is that every consultant in the world will go, well, Mr. Market says 4 to 6, so I won't accept it. I'm going to go hedge fund, I'm going to go private equity. So the amount of money flying there is enormous. And the returns, one of the is, they're actually private equity. He just raised something close to $1 billion. What are they doing with the money? They're making loans. High-risk loans. He's got all these great analysts. Instead of buy a company at an all-time multiple of 12 times EBITDA, they're making loans for 10, 12%. They're taking credit risk, but that's the only place Mr. Marcus got it. So this herding, we all ran to hedge funds. That didn't work. So now we're all going to run to private equity. They go back and forth, and some sticks in private equity, and pretty soon indexing, then pretty soon say, gee, maybe active management's worth it. Yes, sir.
As an industry, do investment managers need to be better communicators during periods of underperformance?
Oh, absolutely. Absolutely. I believe that when you're underperforming, you should not be defensive, but you should be more communicative than ever. When you're outperforming, you should have humble pie and communicate. And this is part of our standard. A book doesn't go out for a meeting that we don't have this, so that when we're up here pounding the index to death, we start talking about, now remember, someone's going to start coughing in the third row. And remember, this is not permanent. That there are times we'll do better or worse, And so humble pie is really important because you create expectations. And when you're outperforming, you should say, now, this is good, but this is what it happens. And you probably outperform in a down market. But there'll be a time when this index will be above us again, and we'll teeter-totter back and forth. But you'll always be on that line, is what I say. And with a portfolio with us, with these characteristics, that's your Occam's razor. And I think if you do that, you create, manage expectations, communicate candidly, forthright, and when you screw up, hey, we had a bad year. You know, we did this wrong, or we had a bad year relative because we don't do high tech, and you didn't come to us for that. So, and that's why this benchmark's important. It's a tool. It's not the bogey. And if you build your business on trust and communication, you invest with us, this is what you're going to get, and then by God, do it. And when you do it, explain to them why it's good and bad. And you get that going, and it becomes, what happens is, over time, your retention will stay with the people, and you'll lose the people, and then pretty soon you've got this pyramid of people, like-minded investors, who get it, what you can and cannot do, got to deliver, but that's a better business. And it's not selling performance, it's also anticipating it's going to get better, but it's going to get worse. So just being candid. It's amazing the sunshine's the best theorem in the world. We're running out of time, so one last question. Is it okay? I got the nod. Yes, sir. You were, but one though, none of this two stuff. Now open-ended.
I'm really concerned that DOL, either explicitly by the regulators or implicitly by the providers, is going to result in a menu of only passive options, because investors could basically have a quit and sue if you want to perform an index. Have you ever seen that in your career, and as you think about that, do you think it's likely?
It's happening now. It's happening now. This fiduciary thing is well intended, and the rules, as I understand them, because I tried to understand them, doesn't affect us, are really scary. Because if you have an IRA and they come out of a 401k, you got to tell them your fee is going to be higher, which is by definition. It can't be any cheaper, I don't think. And that you may or may not beat the market. So why would you do that? And then it goes further. You got to tell them what this would do and what you're going to do 10 years out. That's insane. You don't have a clue. And if you tell people, they're going to actually believe you. Which is worse, because you're going to get sued, because you're going to be wrong, because you're going to tell them you're going to beat it. And so that's what's happening. And the investment, the brokerage, forgive me, not yours if you're one of them, but the brokerage firm loves this. Why? Because they take her out of the stock picking business, and she stinks. And she gets a fee for turnover. Asset management, they get 1%. So what have I done? I've reduced the brokerage risk of picking bad stocks, people unequipped to pick stocks, and I've replaced it with an asset fee that goes up, we get a fee, and I've changed the business risk of my brokerage business from encouraging people for turnover and encouraging people for long-term growth. So that business is a lower risk in terms of liability and other risks, and it's a better business. So they love it. It's actually really good for the brokerage community. And this whole fiduciary thing was aimed at primarily the brokers. So we're here. And so we go back to the stewardship thing. We, the CFAs, had better make sure continue to be the gold standard. And I'm naive enough to believe that money will flow. Thank you. Good luck. Nice to have you.